On January 29th, 2026, gold hit $5,595 an ounce. An all-time record. The world was at war, inflation was sticky, and central banks were buying gold like it was going out of style. 49 days later, gold is sitting at $4,500. That's a drop of 18.5% in 7 weeks, during the exact kind of crisis gold is supposed to protect you from. So what happened? Here's the part most financial news gets wrong. When oil spikes, and right now, with the US-Israel strikes on Iran, oil has crossed $100 a barrel for the first time in years. It doesn't just raise gas prices. Oil is a tax on the entire economy. Every dollar per barrel increase pulls money out of consumer wallets, slows manufacturing, raises shipping costs, and chokes business margins. Enough of that, and recession fears kick in. And when recession fears kick in, people need cash, fast. That's where gold becomes what analysts call the ATM of last resort. When margin calls hit, when leveraged traders are watching their portfolios bleed and the broker is demanding payment, they don't sell their losers, they sell whatever is liquid, and gold is the most liquid asset on the planet. So gold gets sold, not because it's failing, because it works. Layer on top of that, the Federal Reserve just held interest rates steady at 3.5% to 3.75%, and its tone turned hawkish. Why does that matter? Gold pays zero yield. When real interest rates rise, bonds suddenly look attractive again. 10-year inflation-protected treasuries are now yielding 1.74%. For the first time in years, bonds are competing with gold for institutional money. Three forces hitting simultaneously: forced selling from margin calls, dollar strengthening as a flight to safety trade, and a Fed that just made bonds more attractive than bullion, for now. Here's what that 18.5% drop actually is: a fire sale, not a failure. The paper gold market, where futures contracts, ETFs, leveraged positions, is not the same as the physical gold market. Paper traders got squeezed and sold. Central banks did not. The World Gold Council reported that central banks bought 863 tons of gold in 2025. Poland added 102 tons. Brazil re-entered the market after a 4-year absence. Kazakhstan hit its highest level of annual buying on record. These buyers did not react to last week's sell-off. They are not reacting to this week's sell-off. Their timeline is measured in decades, not days. This exact pattern happened in 2008. It happened in March 2020. Gold dropped hard in the initial panic, then recovered and set new records within months. The 18.5% decline shook retail investors out of their positions. It did not change the structural reasons gold spent 2025 hitting 53 separate all-time highs. Here are the numbers that matter. Central banks bought 863 tons of gold in 2025, nearly double the annual average from 2010 to 2021. Total global gold demand topped 5,000 tons for the first time ever. The US alone doubled its gold demand, driven almost entirely by ETF inflows. JP Morgan's year-end target: $6,300 per ounce. Deutsche Bank, $6,000. Goldman Sachs, $5,400. Not one major institutional desk moved its target after this week's crash. The fire sale is real. The story is not over.